The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hi, I'm Esther Gulius, the tax lady, and we're wishing everybody Merry Christmas from EG Tax. And you know what this means? It means like 8 days to the end of the year, which means it's the end of the everything that you can claim as income and everything you can deduct as expenses. So right after Christmas, you guys got to get busy and do everything if you want to impact your 2018 tax return. And I'm joined in studio today with Tiffany Fabian.
Hey there, Esther. Happy Saturday.
Well, Merry almost Christmas Eve.
Yeah, very
and Christopher
exciting.
Fabian.
Hello, Esther.
Now, you guys got all your shopping done?
Well, just about. I seem to do it in phases. First, I do the people who live out of town, and then I do you, and then I do my kids. I seem to do it in phases. So my phases are winding down.
Good. Well, that's good. And
Yeah.
also your check.
Chris is always
probably.
Yeah, it's a checkbook.
Chris
too.
is always the last one I get because I think if there's anything left, we get each other gifts.
Oh, well, that's good.
Yeah.
That's good.
Yeah.
I'm Esther Gulius, the tax lady from EG Tax, and starting January the 1st, we have a brand new tax season filing starting until April the 15th. It is April the 15th this year.
Yes,
Correct.
it is.
It
It
So
is.
that'll be weird.
First time in a long time.
We haven't done April the 15th
But
in
it's
a long
so
time.
weird because the IRS doesn't accept e-files till later.
All right,
in
and so that's part of the problem we want to
Yeah.
talk about. And again, this is one of those. This is one of those sessions where we're not taking live phone-ins. We will next week again, but today we're doing your emails, kind of chewing them up. I think you'll find it very interesting because we go into a lot more detail when we have the opportunity to do so. But starting January the 1st is a new filing season for 2018. Gigantic changes.
Yep.
I mean,
yep.
hurt your head changes.
Yeah.
You know.
Uh,
So, and we're going to talk all about that.
My clients have been calling, and the other ones, the ones lately have been saying, "Oh my God, I feel so sorry for you. You have to do 2 tax returns." Really, my clients have
figured it out.
They figured
Wow.
it. Well, I
And
mean,
with
they
2
figured it
tax
out
returns,
after I've been
We've always
talking
been
to you.
doing New York State and federal, but the state has always pretty much piggybacked on the federal. So it was. So once you did the federal, everything kind of flowed over to the state, and you did a couple adjustments for one thing or another, but pretty much the federal and the state were in sync. Now, the state, because I think the state was pretty much, what's the word, verklempt.
That's my wife's word.
Over the federal government saying, we don't really care that you guys are a high property tax state. We don't care that you pay a bunch of taxes, and we're going to cap the deductibility of taxes, state and local income taxes, at $10,000. And I think the state of New York said, you know what? Then we're just going to say we ignore you and all of your changes, and we're going to let everybody do just like they did in 2017. So even though it's not deductible on the federal, by gosh, on New York State it is, which means that you have a set of federal rules which are completely new, and you have a state rules which are completely old. And so people that are not going to itemize on the federal can itemize on New York State, and all those things that are not deductible on the federal are deductible on New York State. And so that's good for New York State taxpayers, except it makes it a lot more complicated.
Indeed.
Right?
Indeed.
But to their benefit.
Yeah,
So if you end up with an extra $10,000 in itemized deductions on New York State, it's going to save you like $800 in taxes. Good for New Yorkers, but it's like mud in the eye for the federal government.
Yeah.
Right?
Yeah. Well, and I'm proud of New York State for doing that because we do pay really high property taxes, and so they're
And
trying
state and local income taxes.
Right. So they're really trying to take amends to what's going on. And also, with that being said, it's so important. New York State is going to be holding the purse strings, so you might want to adjust your withholdings on
that
New York
is true,
State.
and because New York State is now going to become the detective to make sure that what you claimed was absolutely correct. I think that's Santa Claus calling.
No.
All right, so I'm Esther Golias, the tax lady from EG Tax. Our website is egtax.com. If you need the latest in all the tax law changes, you can go to our website. All of our 30 offices are going to be open on January the 17th. The IRS is not going to allow electronic filing till when? Do you know, Chris?
Supposedly they're not going to accept returns to the 29th.
But we have
but the thing is, we have everything all set, so you can come in with everything. We'll have it ready. We'll have it stockpiled, and we'll send it off. And as soon as they accept it, we'll send it off right away.
Yeah, and we also have a product. Tell them about the product if you need your refund quicker.
If you do need your refund, we do have easy advances available.
Well, it's not a refund; it's a loan.
It's a loan, right, that you can apply for through us. We do your tax return without the IRS accepting it, and the third-party bank can give you part of your refund.
And so that's good because when you think about it, they're not going to be issuing refunds with people with all these refundable credits till way late into February.
Yep.
So if you're somebody that says, oh, my gosh, I need this money to pay up my Christmas bills, the easy advance may be something that you'd want to avail yourself of. There is no cost for the interest on this loan. Is that correct? The interest on the loan is tax-free.
Chris has been calling
it's free.
Right
Yep. As far as I know of right now, yes,
right.
Our third-party bank is not charging interest.
All right, because I believe the state of New York doesn't allow it. All right, why don't we go to
I
our
got
email?
a question.
Yeah.
This is Tony from Buffalo. Esther, I hit the lottery pretty big this year. I got winnings, but I lost another $50,000 or so. If I only have Social Security of $22,000, do I still have to file? Tony said this. And so the answer is, if he had $50,000 in losses, I wonder if he's alluding to the fact that he had $50,000 in winnings. And if he did, then he would have to file a return.
Okay, so here's the thing. Your losses up to your wages are going to be deductible.
Right.
Up to your winnings.
Up to your winnings. Excuse me, wages. Up to your winnings are going to be deductible. So, but unfortunately, let's assume that he won 50, right? That's going to make his Social Security 85% taxable, right?
Yep.
And so his adjusted gross income is going to reflect the $50,000 in winnings plus 85% of his Social Security. Then it's going to be further reduced by his itemized deductions. Then his standard deduction sounds like he's single. He's going to end up with taxable income.
Right, and he can write off those winnings up to his losses as an itemized deduction. And this year, pretty cool, if he had to, he could also include transportation included in that category for gambling losses. So if he had to have an airfare or a bus.
That's the sad part with people that are gamblers. They don't realize that
the taxability of their Social Security.
It ends up taxable even though you get to deduct it.
Right.
It ends up making your Social Security taxable. So in his case, almost $18,000 of his Social Security is going to be taxable.
I know Tim has been helping a lot of people with the IRMA increases in their Medicare, and this one older lady comes in and says, I don't understand why it went up. And Tim looked at her return and said, well, you won $220,000 at the casino. Yeah. And she goes, yeah, but I spent $250,000. Well, that's because your
they only
winnings
look at your adjusted gross income.
used to be what's called page one.
Right.
And they don't look at your taxable income, they look at your adjusted gross income. So
right, so even though later on you can deduct it, you can't deduct it up front, and it makes your Social Security more taxable. Yep. So that was a good question. Well, all right, I'm Esther Golias, the tax lady from EG Tax. We're here in studio with Christopher Fabian, Tiffany Fabian. Merry almost Christmas, and we're going to take a short break, and we'll be back on the other side. Hi, I'm Esther Golias, the tax lady from EG Tax, and we're talking emails today, and we're wishing you a Merry Christmas. I hope you have a wonderful time with your family. Remember that not to get upset because family, you think that you have this extra latitude of saying, Uncle Pete, you're drinking too much. I mean, cut everybody some slack. Have a wonderful Christmas. And remember, in about 8 days, it's the end of the year. So anything you're going to accomplish to reduce your 2018 tax return is got to be done this week. But we're talking emails. We got another one here.
I do. Bill said, tax lady, my daughter just turned 23 and is in graduate school. She makes about $8,500. Do we still get to claim her? Bill. And so
if she's in, it doesn't say how old she is.
23.
Oh, she's 23.
And
All
so
right.
the law says you can claim your kids up to the age of 24 as long as they're in school full time for at least half of the year. So as long as you provide more than half of her support. And so the answer is yes, Bill, you could still claim her. And then you also get the college credit.
All right, but they're not going to get. Since it's a graduate school, they're not going to be getting the American Opportunity Tax Credit.
Right.
They're going to get the lifetime learning.
Right, and they're also going to get the $500 family credit for
brand
her.
new credit this
Right,
year.
right,
Brand
which is
new
pretty
credit.
cool.
For anybody that would it's a qualifying individual over age 17 or older.
Correct.
Right?
Yep.
Correct.
All right. And on the state of New York, would they get any kind of credit?
Nope, there's no credit on New York. You still
Because-
get your personal exemption
Right.
for her because New York State has, dependent exemptions.
Right.
So you'll save a little bit on New York, but the big savings is
on the federal.
Is the federal. So up to $2,000 lifetime
And
learning.
then I
how
want to
about the
say that she has to do her own return. I did
was just gonna say.
somebody's return the other day who actually added his income, the daughter's income, to their return, and that's not what you should do. She should do her own return and
Right.
indicate that she's a dependent on somebody
Right.
else's
And now,
return.
is she going to pay any federal taxes making $8,500?
None at all.
On the state, will she
Yes.
pay? Yes. So on the state of New York, her standard deduction is a little over $3,000,
35.
and on the federal, her standard deduction is $12,000. So she won't pay any federal, but she will pay New York State.
Yep. Yep.
Okay. All right, let's go. What else we got here?
I got Mrs. Smith. She said, my husband, Esther, needs a new laptop for his business. I was thinking of surprising him at Christmas. I thought I heard you say something about buying deductible Christmas gifts. Would this qualify?
All right. Well, it's interesting because we don't know if he's self-employed or if he's an
Well,
employee.
for his
It says
business.
his business.
Yeah.
So we don't know if he's self-employed.
Right.
So the good news if he's self-employed is, will it qualify if he's using
Yes.
it for business?
Yes,
If he's
yes.
if he's an employee,
No.
Maybe
on the state it would qualify,
on the state.
right?
On the state, it
But
would.
not on the federal.
But not on the federal.
Right, because of what we talked about earlier, how the federal has one set of laws, New York State has their other set of laws. So on the federal, they took away business expenses for employees, not self-employed, but for employees. New York State says we're going to go back to 2017 law, which lets you claim those expenses. So yeah, it could help you on New York State. I mean, and depending what type of job he has, if it is an employee, then, his mileage, his dry cleaning from
Maybe
out of
office
town,
and
his
home.
travel, office and home, all those other expenses will help you on the New York side of
And
things.
there are, for those of you that have like one day left to go Christmas shopping, there are deductible Christmas gifts. If you are buying for your spouse or maybe a family member who's self-employed, if you give them a gift and at the fair market value when they place it into service will make it tax deductible on the federal if they're self-employed. If they're an employee, it won't be deductible, but on New York State, it will be deductible. So it's yes, no, yes.
Right, and if that was, we were talking a lot if it was an employee, but what if he was self-employed? What could they do with that whole cost
They can
of
do
that?
a 179 election and write the whole thing off.
Right, which means,
And then don't forget about the 20% pass-through. Go on, Chris.
that's depreciation. Instead of writing the computer off over 5 years, so we'll say if the computer was $1,000, you get $200. Keeping it simple, $200 for 5 years. You could elect to use it all in 1 year and take that full $1,000 off to help bring down your net
Right.
profit.
Again, that's only if you're self-employed.
Self-employed.
So you have to remember, employees, niet. Self-employed, da.
Yes, no,
That's
yes, no.
speaking the Russian, because we talk about Russians all the time.
Yep.
Okay, what else we got?
I have Bart from Depew. Tax lady, my son Norman has a lot of money set aside for college. Last year, his investments made around $8,500. In the past, he had to pay kitty tax at a 15% bracket about. Since he's 18, should he claim himself? Bart from Depew.
Okay, well, that you really have to put the pencil to the paper on this. Because here's what happened. If your children that are being claimed as dependents and if they're in college until they're in college up to age 24, if they have unearned income, and that includes unemployment and interest and dividends, then there is a possibility that they have to pay taxes, and it used to be at your rate.
Right.
And
Which
so
was the
if you're in the
15.
15% bracket, Mom and Dad, that's what they said. They would have paid 15% on the kids' unearned income. This year, though, they said, we're going to simplify it. They're going to simplify it and chop you in the neck because unearned income is going to be taxed at a kitty tax rate is going to be at a rate like on a fiduciary or a trust, which is much higher.
Right. He would pay about 24%.
So he'll end up paying an extra 9%.
And so what you said, Esther, is really true, is they should run the numbers both ways, Mom and Dad claiming them and then him claiming himself, and see which way yields a better answer.
But I sort of agree with that one. But if you do the math, that's only $2,000 in taxes, roughly.
Right.
How much will the AOTC give them?
Well, that's what you have to figure out.
I mean, that's a possible
Doesn't say he's in
$2,500.
college.
Yes, it does.
Oh, you set
and then
aside
$400
college.
on
Has
the
a lot of
state,
money
so
set
that's
aside for
$2,900.
college.
Right,
So
plus
they're
the
all-
500 family credit.
So then the family comes out about $1,000 ahead. But the thing is, you have to think about it.
Yep.
Right, you
plan.
just can't, and parents, I think, will be appalled to think that their kid on this $8,000 is going to pay that much in taxes.
the
But
worst-
that's the way it goes. Now,
The worst
a
part is
lot of
it's
people
scholarship
that are
income.
socking away money into their kid's name really need to think about this, right?
Yep. Oh, definitely.
Because with it being taxed at the trust rate, it ends up being a great big number, and maybe you want to hide that money. Maybe you want to buy U.S. savings bonds, right? If you put the money in a savings bond, the money grows tax deferred, and it doesn't show up, and there's no kitty taxes, and you could buy an annuity. I know a lot of people don't like annuities, but that's another thing that you could do. Or you could buy. Of course, you want stocks that are paying dividends, and the dividends would be taxable.
But if you put it in your name, if you
can
put
keep
it
it in
in
your
the
name,
parent's
right.
name,
That's what
yeah.
But
also, this is just his investments. If you look about kitty tax is anything unearned income.
Right.
scholarship money.
So excess scholarship money is unearned income.
Right.
What do we mean by excess scholarships? Anything that's not
Housing,
used. Yep.
food,
Anything not used
living
to pay for
expenses,
tuition and fees
a stipend.
and books.
Right.
So
So the whole thing is, it used to be a few years ago when we would say, "Oh, you got a baby, just start putting 529 plans are a good thing too."
Yeah.
Yep.
If you put money in the 529 plan, because that's also not going to happen. But let's say that you got a baby, and you say, let's start building up the nest egg for college for the kid. Now, with the change in the tax law, you could end up paying taxes on this money at a trust rate, which would be at a much higher rate. So there is alternatives, and that's part of what we do, right?
And then don't forget also that this person would get the college credit on New York State for their son too, and
Yeah.
so that's money in their hands too.
I think we said it's about $1,000 over what they would pay
Right.
in kitty tax. But still, it's not like, now think about this. Let's say Norman, they put all this money in U.S. savings bonds, which they don't cash. And let's say the savings bonds are growing, but you don't have to pay taxes on it. They're saving the tax of almost $2,000, and it's growing tax deferred. So that's another thing for Mom and Dad to think about. U.S. savings bonds don't pay a lot, but it is growing tax deferred. So that's something you want to think about.
I got another one,
Yeah.
and we could carry it over after the break. It says, Mary from Williamsville, EG tax. Since my major write-off has been $15,000 to charity, and my taxes are $3,000 on my house, only a home equity I used to pay off credit cards of $2,000. I did pay sales tax on my new car of $2,500. I'm 71 years old. My IRA is $25,000, Social Security $20,000. $20,000. Whoa. Long question. Investments $3,000. Do I lose the deduction? Mary from Williamsville. Well,
Okay,
it sounds
so
like
we
she's
gotta
single.
add 15 and 3.
Because the new standard deduction
and she
for a
can't
single.
take the credit card interest, right?
The
home
home
equity to
equity.
pay up because
Not on the federal.
Right. Changing the tax law this year, if you have a home equity that was used for anything other than, or any mortgage, for acquisition indebtedness or remodeling, it's not deductible anymore.
Yeah.
So she has.
And now while Esther's adding up the numbers, the new standard deduction for a single person is $12,000 plus because she's over the age of 65. She gets an extra $1,300.
$1,600 if she's single.
If she's single, so that means she's going to be at $12,000 plus $1,600.
She gets about an extra $5,500, right? In itemized deductions over 12. No, because her
No,
standard
over
deduction.
7,000.
Her standard is $13,600.
Yeah. So she's up about 4,000 in itemized deductions. But if she did, because
she's got
15,000
and
plus
3
the taxes of 3, 18
plus her home
the-
equity.
Oh,
Not her home
no,
equity,
not
her
home
sales
equity.
tax.
Sales
Yeah,
tax.
all right, so
the
that's
new
20.
car.
Right. So she's by 7,000.
All right, by 7,000.
So the answer is yes, you can still itemize.
yes, however,
And
had
then on
she
the
done the rollover from the IRA into a charity, right?
right.
Then she would have gotten the full benefit of the 15,000.
Right, right.
So her IRA was 25. Only 10,000 of it would have been taxable. Right.
Right.
Which means she wouldn't have paid any taxes at all.
That's
so
right.
what's a new tool that people should put in their tool chest is to do the rollover. If you're somebody that gives to charity, from your IRA to the charity, which would make it completely not taxable to you, and it fulfills the RMD. And we got a break for news. I'm Esther Gullius, the tax lady. See you on the other side. I'm Esther Gullius, the tax lady from EG Tax. Thanks for listening. Merry Christmas almost. I hope you have a wonderful time with your family. And remember, in about 7 days, the jig is up. 2018 is in stone. There's nothing you can do. And we're talking emails today. I got Tiffany Fabian and Christopher Fabian. And Chris, you want to say something about?
I do. Before we go back to Mary, don't forget our Tax Tip Tuesdays, which is live on Facebook, and starting in middle of January, we'll do it at our office as well, live.
So people can come in.
So people can come in, and we actually had someone, we were 5 minutes late this week because we were doing tests, and someone actually on Facebook, where's Tax Tip Tuesday? So it's already getting a following. So, we give a nice little advice every week. Come listen to that on Facebook Live.
Right,
but
so
going
let's
back
regress
to
back to
Mary
Mary.
about the minimum distribution. So here, you started bringing it up, but we have 30 seconds. 25,000
Is her RMD.
is her RMD
Or
plus her 20,000 out of her Social Security. So you figure, doing the math fast in my head, about 70% of her Social Security is going to count as income. So you're looking at another 14,000. So she's at $39,000
Plus her
her 3. So she's at $42,000.
minus 14.
Yeah. So her taxable income, minus the 20, is about 22,000.
Mm-hmm.
But she gives 15,000 to charity. So if she takes out of her 25,000, does the direct rollover that you said to the charities, and it doesn't just have to be a church, it could be any charity out there. So then that would leave her with $10,000 of her IRA, $3,000 of her investment income. That's $13,000. None of her Social Security becomes
taxable,
income.
right.
Her standard deduction alone, because she doesn't have
Wipes
the
her out.
charity, wipes her out.
So
she
she pays
pays
zero
no
tax.
tax.
So that would be perfect.
Right.
So this is a great tool for people that give to charity, that have to do the RMD over age 79 and a half, because it saves the taxability of your Social Security too.
Absolutely. And the year is knocking on your door.
Right. And so those of you that got to do your RMD, this is a great tool.
I've got Sam and Jen. EG Tax. My daughter is thinking of starting a bakery. What advice can you give us? Should we come in and meet with someone on your team? Is this something you can help with? So the answer
That's
is
like
yes,
somebody
yes.
calling up and saying, I have cancer. Can you solve it over the phone? I mean, a baker, anytime you're starting your own business, you have to think about all the things you have to do to make sure that you're compliant with the state of New York and federal government. First of all, you got to say, do you have any employees?
Right.
Right.
If you do, then you have to do.
You have to get a
do
tax
your
ID
payroll.
number.
You have to make sure you fill out the W-4 forms
Right.
for your employees. You got to make sure you have workers' comp, all that. If it's a bakery, then you're going to be selling to the general public. I'm assuming you have to get a New York State sales tax number, right?
Yep.
Then you have to set up your books, and you have to do a budget. And there's and you got to get liability insurance because you want to make sure, God forbid, somebody gets ptomaine poisoning from your muffins or something,
Right.
or falls in your showroom.
Right.
So there's a lot of things you have to do before you hang out your shingles.
So the answer is yes. They should definitely come in. Chris, what were you going to
Yeah,
say?
I was going to say, I mean, that's just getting started, but what's the best tax entity for them? Should they do it as a DBA? Should they do it as a corporation? Should they do it as an LLC?
Right.
I mean, that's another aspect because, I mean, as a bakery, I don't think personally I would do it just as a DBA. I would want to do an LLC or a corporation. First of all, because you mentioned liability insurance,
Right.
that corporation and LLC has that umbrella of protection, which can help you. Obviously, with this day and age of lawyers, they'll try to sue you personally anyway.
Oh, go on. Go on.
go ahead.
No, you've been. And then also, I think that this is a good time to bring about the 20% pass-through credit. This, for new business owners or any business owner out there, there's a new credit, or if you're a rental
it's a
landlord
deduction,
and you're in business of being a landlord, there's a 20% deduction pass-through, which is really cool.
Based upon your net profit.
Right,
though.
based upon your net profit.
First year, second year. If you make a profit the first year, she must be quite a baker.
Right. I'm talking for other people.
Right. And as a matter of fact,
Perhaps.
if this year she does end up with a loss, right, or let's assume it's next year. Let's say she has a $10,000 loss. What happens with that loss?
Well, on this year's
pass-through.
tax return, it would help offset her other income.
Right.
But for what Tiffany is saying with the pass-through, that $10,000 loss carries forward to next year.
So if next year she has a $30,000 gain, she only gets to pass through on the 30 minus the 10.
And
So
that's
it'd be
why it's
20.
really important that you put the code of what your business is, because also it depends on the code. If you make over $315,000, well, that might be Panera's, not the new bake shop. Then it depends. If you make over $350,000 and you're a service organization, then the 20% deduction is subject to other factors. Restrictions, exactly.
Probably not going to get
Very
it.
good question.
But there's all kinds of things. Yes, she needs help. Yes, she wants to make sure she does everything correctly. And the other thing is she has to say to herself, do I have some deep pockets to pay the rent? Because to think that people are going to say, oh, there's a new bakery in town. We're going to stop going to where we work because we want to go to this new bakery.
It's not Chick-fil-A.
Yeah,
Advertising
right.
is
It's not
so
Chick-fil-A.
important.
That still has an hour drive-through
I
wait.
still think we should open up a Chick-fil-A. All right, we can call it EG Filet.
Jesse Batavia says, EG Tax, my daughter is 23 and she's just given birth to our first grandchild. They both live with us. Due to her pregnancy, our daughter only worked part-time, making around $4,000. My husband and I have income around 90. What do we do this year? Jesse from Batavia.
Okay, well, the first thing I think of is the earned income credit, right? Mm-hmm. And the earned income credit would be for the person that has a qualifying child that lives with them that has wages, and the wages would be, in this case, like under $40,000. Well, that's not mom and dad,
Right.
because mom and dad make 90, so
Right.
they're not going to get that. But Jesse's daughter would qualify for the earned income credit. Now, the mom and dad have the opportunity to claim both their daughter and the granddaughter.
Right.
And they would get the child tax credit for the granddaughter, and
Which
they
is
would get
$2,000
the
this
family
year.
credit for the daughter. So that's $2,500. So really, it's going to require somebody to work it out and say, if
Well,
if my daughter claims the earned income credit and we don't, how much extra is she going to get for the earned income credit as opposed to us claiming the children?
The earned
child
income
and my
credit
daughter.
is a bell-shaped curve. The more you make, the bigger the credit until you start making too much. And so the daughter only made $4,000, so I think her earned income credit is going
But
to be
she's going
around
to get the child
$900.
tax credit with the $1,400.
Not a lot.
No.
But
She'll get part of it.
she'll get a $1,400. Oh, it's a phase in.
It's a phase
over
in
the
because
3,000.
it's over
Yeah.
barely over 3,000. She may get an extra couple hundred.
Yeah, I think, looking at the numbers, I think it might be better for mom and dad.
But again, you can't
gotta
really
run.
do it until. And remember, it's the state of
Yep.
New York as well.
Yep, and we do this all the time. We run the numbers and see which way
So,
yields
and
a better
so
answer.
I think one of the best ways to do it is to sit down, the three of you in the room, mom, dad, and the daughter, right? And say, okay, daughter, here's your refund. And really, the daughter, the mother of the child, steers the
ship.
The ship, because even though she really was living at mom and dad's house, and even though mom and dad were really supporting her, because she's the parent of the child, she steers whether or not the parents, her mom and dad, can claim she and the baby at all.
That's
so that's why it's best to say, okay, mom and dad, you're going to make this much extra by claiming the child and grandchild. And daughter, this is how much you're going to get for the earned income credit and additional and the child tax credit. All right, so let's say that you're ahead $2,500, but we're ahead $4,000. Maybe the $1,500 could be split, $750, but you never know if you don't.
Go
do
in,
the-
wait. Go into a 529 plan for the baby.
Right.
I'm just
All right.
But you know what? Also in this problem, say the numbers do work out better for the daughter. What is the daughter's filing status?
She's single.
Single.
Right, because she lives with the parents.
Right.
But how many tax returns do we see in this situation
could
where
have the wrong
they
status.
put down had a household, but the IRS looks at addresses.
Right.
So if she did had a household, parents did married joint, same address, in about a year, the daughter's going to get a letter saying, we don't think you're had a household.
Of course, the good thing is with $4,000 won't make. any
Right, I know,
difference.
but
that's a
but
great
what
point
they're
bring
going to
up.
do though, the IRS just doesn't change you from head of household to single. They back away that baby from that tax return.
Right.
So where if she got back $3,000 refund, they're going to send her a bill for $3,000 plus penalties plus interest, and it's up to her
to prove it.
Yep, to say, wait, I'm not
But
head of household.
ultimately, they wouldn't win. But unfortunately, what happens is when people get these notifications from the federal or state, many times they just look like a deer in the headlights and they ignore it. And unfortunately, that would be not good. And if you're somebody that's gotten those kind of bills and you haven't answered it, you have to answer it or else they win.
Oh,
Yep.
yeah.
Right?
Yeah.
Levies.
I
What
just
else
helped
we
somebody
got?
with a New York letter the other day. Larry from Georgia. No, it's Larry from Buffalo. It says, EG tax, I've been paying alimony to my ex-wife for 5 years. She just told me starting next year I can't deduct it anymore. Not that I believe her, but could she be right? And so the answer is starting in 2019, if it's a new divorce, you can no longer deduct alimony as an adjustment to income, and they don't have to declare it as income, the person who is
but
the
in
recipient.
a pre
Then thumbs
2019
up.
divorce, unless it was changed,
Right.
She had to go. In this
She'd have
case,
to go back to
she
court.
would have to go back to court to say, I don't want to count it as income.
Right, which is really, oh gosh, that's like taking something to your jugular. That's hard for those people who are paying alimony starting in
Especially
2019.
when you were negotiating, you negotiated a settlement
Right.
back in the day, and you say, I have X finite amount of income, and this is all I can afford, right?
New York State, though,
Is going to be deductible.
it's still going to be deductible.
But all right, let's make sure we have everybody understand. If it's a pre-2019 divorce, nothing's been changed. It's still deductible to the payer, taxable to the payee.
right.
No, deductible to the payee, taxable to the recipient. Now, if it's a 2019 divorce and the payer is paying it, it's not going to be deductible and it's not going to be taxable to the recipient, right?
That's right.
However, in New York State, even if it's a 2019 divorce, it's still going to be deductible to the payer and taxable to the recipient.
Let's put numbers to this. I'm a numbers person. I like examples. So if it's, I know we're coming up to break, but if someone pays someone $100,000 in alimony on a new divorce, but it happens.
Right.
I've had people 144, 200,000, but $100,000, you figure that person who's making that is probably at the 33% bracket. So that $100,000, he's losing a $33,000 deduction.
It's cost him that much more in taxes.
On his taxes. Right. So really, in essence, if that was the old law, that $100,000, he's really only paying $67,000 in alimony because he's getting $33,000 back from that's what it's doing to the person who's paying the alimony.
Right. I mean, it is murderous. All right, we're going to take a short break. I'm Esther Gullius, the tax lady, with Tiffany Fabian, Christopher Fabian. We'll be back on the other side. I'm Esther Gullius, the tax lady from EG Tax. We're wishing you a Merry Christmas, a wonderful time with your family. We're in 8 days. We're back in the saddle here, folks. Any changes that you need to make for your 2018 return, you only got a little time to do it. And we're talking emails. We're not taking your phone calls today. We'll be back next Saturday with live phone calls. But until then, we are chewing up your emails. And we have what?
I got Charles from Lancaster. Esther, we always itemized in the past. I'm an outside salesperson, and I don't get any reimbursements from my boss. Generally, I travel about 20,000 miles a year, plus I work out of my home. We don't have medical to speak of. Our property taxes are $7,000 a year, mortgage interest of $6,000, and we give around $2,000 to church. Do we itemize or not? P.S. My brokerage fee is around $4,000. So, boy, the job expense section of the itemized deduction on the federal is gone. So right off the bat, the sad part is that he won't be able to deduct his mileage for work, nor his office and home for work on the federal.
But on New York State,
he can.
He can take it all, right?
Right.
Yep. Or his brokerage fees.
And his brokerage fees. So on the federal, you're going to take the standard deduction. On the state of New York, you're going to be able to take your mileage, your office and home, your brokerage fees, all the mortgage interest you paid, property taxes that you paid, your church is going to be deductible on the state, but not on the federal. So you end up like having two separate forms of deductions this year. So yes, you can take it as an itemized deduction on the state, not on the federal.
Yeah, and so this also ties into the fact that a married couple, their new standard deduction is $24,000. And so,
of course, he is single. Well, I don't know if he's single, he would itemize,
yeah, right? That's what I'm trying to figure out. If he's single,
well, it says we.
Yeah, it does say we.
Yeah, but this makes me think of the fact that married couples sort of get the old shaft.
Well, they do. Being divorced is much better under this change in the tax law. Okay, let's go back.
I've got Herb from Tonawanda. EG Tax, I want to move to a warmer climate, but my 5 rental houses keep holding me back. If they're worth $700,000 and I've had them for over 30 years, what am I looking at in taxes? Any loopholes for me? So that means they're fully depreciated.
Well, without doing something special, he's going to pay about $210,000 state and federal, maybe a little more.
Right,
okay?
right. He should
so that's pretty motivating.
Right, motivating.
So what Herb has to say to himself is, do I want to pay the $210,000 in taxes, or am I willing to modify the sale to reduce my tax liability? So what's his options? He can do an installment sale, right?
Yep, where he's the banker.
Right.
That's what the installment sale
Right,
means.
so that means that every year when he takes his payments, assuming that 100% of it's taxable, he's going to pay capital gains and interest over the life of the mortgage. Now, that means he's still going to pay probably the same $210,000, but it's a little bit
depending on
his tax rate.
income.
That's true. If it's low enough,
Right.
then he might pay zero.
Correct.
Just state of New York. So the installment sale would be an option. The next thing would be he could do it
An
exchange.
Yep. An exchange is where he could actually take one of his properties and exchange it for a property
Or
in
all of them.
Florida. All of them, and exchange it for a property in Florida.
Or or wherever.
When this
you want to go
happens,
to Alaska,
though,
you can go to Alaska.
you need an exchange mediator to handle it for you. Russ Gullo is one of the only ones that I know of, and I can't tell you the stories that I hear of people who are look into their own law. They call us up and they're like, I'm going to do an exchange. I put the money into my bank account and I'm ready to do the exchange. It's too late. The money has to go it can't go into your bank account. It has to go from the exchange person to the new house.
Right.
Right.
Or from
property.
from the sale to the exchanger. You cannot touch the money.
You cannot take the money. You have to.
All right, so let's explain what an exchange is, Chris.
Well, it's what it sounds like. I'm gonna exchange. It's like, it's Christmas time. Aunt Sally gave you an
ugly sweater.
An ugly sweater. You go back to the store and you say, I don't like this sweater. I want this sweater. Oh, okay. You're gonna exchange that sweater for this sweater. Well, that's in essence what you're doing with your house. I don't like this house anymore. I want this house.
But it has to be investment or business, again, rental.
I think the beautiful thing is if he moves it to Florida, and when he sells in Florida, there's no state tax in Florida. I think.
That's correct. The other thing is, if he gets real lucky and dies, there's going to be no tax.
Well, I was going to
at
say,
all.
another option would be move to Florida, keep your houses up here, and if because if they're making the money, let them make the money, help you buy your house in Florida. But then when you die, your beneficiaries get a stepped-up basis.
That's true, but of course it makes it very difficult to manage properties long distance.
Yeah,
but so doing an exchange, like let's say he's got those 5 houses, he might say, you know what, I want to do an exchange because I save all the taxes, okay? But let's say he's got the $700,000. He can exchange it into like a family dollar. I know that you can become a part owner in a big corporate thing, and basically it's passive income, and the whole thing is tax deferred, and somebody else is running it. So he can be in Florida enjoying himself with all this money that he saved in taxes. The important thing is there are options out there, and if you're not aware of the options, ignorance is a really sad thing.
I know. But Russ stopped in the other day, and he goes, it's unfortunate people don't realize the time frames, the different rules that go into play. He goes, he had a couple. They have farmland that they bought 80 years ago. They're older, or maybe not that. Maybe it's been like 70, but the state came in and did
eminent
domain, gave them a check for $1 million and said, oh, go see Russ. He can help you. They actually told him, go see Russ.
And they gave him the money first?
They gave them the money first. They put it in the bank.
They knew part of the law, the person who gave
well,
them the
New
money.
York State, but
it's too late. They
it's
gave
too
them the
late.
money.
Taxing
too late.
agency,
So now
unfortunately,
They
does have
had to
taxes.
know before this that there was, the whole thing is, I love the couple and all that stuff. But the thing is, if you're getting letters and you know it's going to happen, talk to us first. There's no charge. Our talking is free, right?
Yep.
We'll be very happy to point you in the right direction. I was speaking of that, starting January the 17th, all of our offices are open with real people
Saturday.
that'll answer your questions, too.
That's right.
Okay, what else?
We got Leo. Leo. Esther, can you please help me understand the credit for buying solar panels? The salesman said that I get to get back about 50% of the cost on our taxes. You know what they say when somebody says something that's too good to be true. Das Leo.
Okay,
and so you first want to
tell poor Leo
make sure you have a tax bill.
Right.
Yeah, well, there is, between the federal and New York State, it's about a 55% credit. The thing is, it's a non-refundable credit.
Which means?
You don't get the excess back. So if your federal credit, we'll say if you spent $20,000 on the solar panels, you get a 30% credit. That means $6,000. So, but if your tax liability is only $2,000, you're only going to get $2,000 this year. Then that other $4,000 credit rolls forward to next year. So it may take you 3 years to get that 30% credit. And the same thing for New York State. It's a 25.
If they even have a liability.
That's what Yep.
I mean, and so here's the thing in this couple's case. Let's say they got an IRA, and they should really think about taking the money out of their IRA so they have taxable income
Right,
if they're not
right,
up to that
right,
level.
right.
So that they have something to offset the credit against, right?
Yep.
So you have to think deeper. The bottom
this
line
guy's doing
is
the
a
right thing and
salesman
asking.
or a salesperson is a salesperson.
Right.
So whenever somebody gives you some kind of tax information, double check.
And that's what Leo's doing the right thing. He's doing his due diligence and checking before he signs
because
on
I
the
know
dotted line.
someone who did do buy solar, and they're going, oh, I'm going to get. They're giving me the other half of the money. They're giving me an interest-free loan. So once I get, I get my refund, I can pay it off. And I said, oh, that's great, but let me run your numbers. And I said, you don't get a credit.
Right.
Well, what do you mean? I said, you have no income. You have no income. There is
So
no.
that's where
that
you need to
alludes
say,
to
do I
Esther's
have
point.
any income? Do
Yeah.
I got stocks I can sell?
Right,
Do
that-
I got
that ties
IRAs
into
I can
what
get? Do I have
Esther
an
said.
annuity to cash in? If not, then what they're telling you is just a pipe dream.
Yeah.
Yep.
Okay,
Yeah.
let's see if we can do one more here.
My son just started college in January. Asked Greg from Amherst because he worked after high school graduation, thinking he wouldn't go to college. Then, out of the blue, he decided to go to college. He made $6,000 this year. Can I claim him, or do I put his wages on my report? Greg from Amherst.
All right, so first of all, the kid, assuming that he graduated, then he went to school at least 5 months out of the year last year.
Right.
So he would qualify as a dependent.
Yep.
Right, number one.
Yep.
Number two, if he's going to school in January, the American Opportunity Tax Credit would be available to them even on an expense from the first quarter.
Right.
Right? So they're going to kind of get a credit on something they haven't even paid yet.
Right.
So
And then also they get the $500 family credit for
Right,
him, which
for
is
him.
really nice.
Right, so-
and then also in New York State they get the college credit for him too.
So yes, and yes.
And no, you don't put his income on your tax
No, God
return.
forbid.
You're going to do a tax return for him, and you're going to indicate that he's a dependent on your return, and he'll get all of
and
his
he's not going
withholdings
to pay
back.
any taxes on his $6,000 on
Right.
the federal, but he will on New York
A little
State.
bit on the state.
Okay, well, I'm Esther Gulius, the tax lady from EG Tax. Our offices are going to be opening on January the 17th. If you need the greatest tax help for the least fees, and I'm telling you the least fees, you want to give EG Tax a call. Our website is egtax.com. Until next week, I'm Esther Gulius, the tax lady, Christopher Fabian, Tiffany Fabian, and we just wish you and your family a Merry Christmas, and we're very thankful for your listenership, and we're thank you for you using EG Tax. Have a great day. God bless. Bye-bye.